Welcome to NavTalk Series 3. I'm Simon Prowse, your host. NavTalk is a podcast where we discuss a broad range of topics which will be inspirational and at times fun. NavTalk, brought to you by the Navwealth Financial Group, helping you reach your destination in life on purpose.
Hi guys, and welcome back to another edition of NavTalk. I'm Sally Prowse, the project coordinator here at Navwealth, and I'm going to be taking over the hosting again with Daniel.
Hello everyone, my name is Daniel. I'm one of the financial advisors here at Navwealth. I've been here for more than 5-6 years, and I'm really glad to be here to have a chat with our mortgage specialist, Sally, about the hot topic, home loan.
Yeah, and first home buyers. So Sally is the Director of Finance and Lending here at Navwealth. Hi, Sally.
Hi, Jami.
Thanks for coming and talking with us today. So to kick it off, we want to talk about the importance of loans and getting pre-approved for your loans before you go bidding on your houses. So how important is it for first home buyers to get pre-approved for a mortgage?
So what you'll find, Jami, with a few banks at the moment, because we found over the last couple of years that they spend a lot of time with pre-approvals, and because of the lack of stock in the market, a lot of buyers actually miss out at auctions. So what they've done is to streamline that process. They've made it really fast, and they just rely on what is actually input into the system to spit out a pre-approval. So one of the major things I believe with first homeowners is that we need a full assessment. So there are banks that will actually do a full assessment, and what that entails is them actually looking at all the income documents, all the expenses, to making sure that that pre-approval will go through to a formal approval in case they do buy a property.
Yeah, so what would be the normal, I've got a young couple comes to me once, says, I want to buy the property. I don't know where to start, right? That's sort of the normal question we get from maybe a young couple, 20-year-old. And so what is the sort of the message you would have for this couple, for example? Why is it so important to get a pre-approval compared to, I just don't get approval, just find a property and start the whole process? What difference would it make?
So the main thing is, I call it the 3 S's, and it's called serviceability, security, and strength of character. So the first thing the banks are always going to do is look at the serviceability, which basically entails income and expenses. And with the increased cost of living basically every month, the bank will actually increase their minimum monthly expenditure. So whether or not you think you spend that amount, the banks assess what your monthly living expenses are on what they have determined, which is sometimes just based on postcode and actually their income. So you as a person don't know. So you may be living at home with mum and dad, for example, at the moment, if you're a first homeowner, and you might do your expenses, and they may be a quarter of what the bank actually thinks they are. So I think that is one of the really important steps, to know what the bank is going to use for your living expenses on a monthly basis, because that will make a massive difference into how much you can borrow compared to what you think you can borrow and what you can afford. The other thing is that banks actually put a 3% buffer on the actual interest rate. So even though today you're probably paying around the low 6s for a home loan, the banks will actually assess that loan at 9%. So it's a big buffer in there. So I do get the question a lot, say, well, how am I ever going to afford that loan if the bank's only going to lend me this? Because they will assess that on that 9%, which is obviously not what you're paying, but they have that security booked in there. So the first thing is just to work out what the servicing is, and by you just putting your income and expenses that you think online, you're not probably going to get the most accurate result as what the bank will see that as.
Yeah, absolutely. I totally agree. When I searched online, right, I can find 10 calculators by just searching it, right, from offers from different banks, different brokers, different sources, and all gives us the various sort of the range of how much I can borrow. So I really don't know what information or which calculator should I rely on, right?
Yes, so you should be relying on what the bank sees, because it's not always what you think. And I think living expenses is the biggest thing. There's obviously in the media every week about the increased cost of living, and that does go into account with every bank calculator, which can be different to the online calculators, which may not be updated every month like the banks want.
So I guess then what could happen is, if you don't have the pre-approval ready, you thought you can borrow, I just put a random number, 800,000, and you get the property for 800,000. And it turns out once you lock in the contract, you go to the bank says, oops, sorry, I can only give you 700,000. You need to come up with the difference, right?
Yeah.
That could be a stressful event for the clients.
Correct. The other good thing I wanted to also state with a lot of banks, especially with the first homeowners, will actually hold that pre-approval if it's been fully assessed for 3 months. So what that means is once you've in that 3-month period, if you do find a house, all you need to do is send us the contract and probably an updated payslip because I want to make sure you're working. But if, say, for example, the living expenses have gone up from 3 months ago, they will actually keep it at that rate from 3 months ago. So
That's
is another good thing for a pre-approval.
Yeah, awesome. And just from experience of looking at properties myself, I know that a lot of the big like realestate.com and Domain, they actually give you a breakdown of the loan costs when you're looking at houses, and it says this is going to be your repayments. So how do you differentiate what the bank will give you compared to what that gives you? Is that still the same as doing a calculator? It's not as accurate as what you would expect, because I'm looking at houses that are like 800,000. It's saying my repayments is only going to be 1,200 a month. But I know for a fact, just from going and getting a pre-approval with you, that that's not the case.
I'm not quite sure what the realestate.com are actually, as I said, like rates are changing all the time as well as living expenses. And most of the banks maybe advertise their buffer rate. I'm not quite sure. It's not general, or they might be doing interest only as opposed to principal and interest. There's all sorts of different ways to sort of have a look at that. So I'm not exactly sure where realestate.com and Domain actually get their figures from.
Yeah, so I'm more taking a perspective of if someone doesn't come and get a pre-approval and they're just looking at houses thinking that they can service for that amount of money, looking at the repayments on the app, they go, oh, okay, I can afford that, when in hindsight that obviously isn't true.
That's probably accurate. So it is always, I tend to try and work backwards as well when I'm talking to first homeowners. It's maybe on the other end, the bank might be able to lend you a whole lot more than you actually really need to borrow, but then actually having a look at what the monthly cash flow does to your situation is also very important, because you may be able to borrow, say, 1.5 million, for example, and then when they find out what the actual repayments are going to be and they've been living at home with mum and dad, that's quite a scary proposition. Yeah. And when you actually do your monthly budget. So I do believe it is very important to have sort of a monthly budget and how that actually going to affect your lifestyle.
Absolutely. I guess, yeah. From what I'm gathering is sort of pre-approval give you some sort of peace of mind and some certainty, right? In this world, you don't know, whether the interest rate is going to change, what banks are going to offering, and with the rising property price, which runs crazily in Sydney, I guess a bit of certainty absolutely would help.
Yes, definitely. Yeah. And although people may be not even just living at home, they may be renting, and they believe that the mortgage repayments may be the same, but with the increased rates, it is actually quite scary sometimes about what that weekly repayment does look like, whether it is in line with what you're paying in rent. And so we normally look at, like, what are you paying at the moment weekly? How much are you being able to save of that? And then can you actually afford what that mortgage repayment might be when you buy the house?
Just off that, can you explain some different types of mortgage options that are available for first homeowners?
Well, unfortunately, the fixed rates still aren't amazing. So when we look at what we're going to borrow, we always want to basically have an offset account, because interest is calculated daily. So we want to have less interest as possible that people are paying. So in a way to do that, we make sure you have the right loan structure. Most banks do have a product that is under a package now that you can have a offset account. What I always say is try and use other people's money as much as possible. I also talk to people about trying to use your credit card, for example, because you can actually get, like, say, for example, 42 days interest free. So if you have your money from your wage sitting against your home loan for, say, 30 days and you're using your credit card and not paying any interest on it, as long as you're disciplined and you can pay that back at the end of the 42-day period, it will actually help reduce that interest, because the main aim is that we want to get rid of that home loan as fast as possible. And that's just one strategy of being able to do that by using, say, a credit card.
So given you have like more than 30 years of experience in the field already, you must have seen, I'll call it, everything that could happen in the home loan field. And could you give us sort of a positive story of, could be, recently or a few months ago or whatever, but basically says what happened for that particular client and how do you sort of end up with helping them eventually?
One story that I can think about this financial year particularly, and I'm focusing on first homeowners here, because the government does seem to change the lending policies for first home because they see the importance of first homeowners getting into the market. So last July, one of the incentives they did do was actually open up the first homeowners first home guarantee scheme, which enables first homeowners to only have 5% deposit without paying mortgage insurance. Before 1st of July last year, you could only qualify for that scheme if you were really in a couple or a single person. So what they did was they saw that there was this gap where, say, for example, siblings wanted to get into the market together and they both couldn't do it separately because of the rising house prices, or even friends. So that is one good news story. I was able to help some siblings last year buy a house. They actually bought it in April last year, but then they were going to do 2 separate loans and they were going to have to maybe do it as an investment and stay at home with mum and dad. So when they opened up this scheme, we were able to go back to a bank and say, well, now we've got this new scheme in place. We've got 2 brothers. Can we now do it together and only pay 5% deposit and they can both live there? So we were able to do that. I think that was a really one way the government was able to help people get into the market and not have to stay at home. So they're now living out of home. So it's good for mum and dad as well.
Mm-hmm. So talking about schemes, do you recommend these for first home buyers and what is actually out there? I'm sure there's a lot more out there that people aren't aware of. Can you just take us through a few?
Yeah, so for the first homeowners, there's a couple of different schemes. So the first one is the first home guarantee scheme, which I've touched upon. So that enables you to have just 5% deposit, up to $800,000. You don't pay any stamp duty. So that if you have $40,000 saved, you can basically get into a house. On the other side of this coin, though, it does make it a bit difficult because if you're a single person, you can only earn $125,000 per annum. And if you're a couple, you can only earn up to $200,000 per annum. So you really need 2 people to be able to get into that if you're going to be buying up to $800,000. They did open it up again last year and they increased the price in Sydney only up to $900,000 where you could get into a property using the 5% deposit. So that's the cap there. They do have caps on all of these as well. And in the regional areas, it's a cap of 650,000. So it's different and every major city is a bit different. I think Melbourne's only 800,000 where that 5% deposit is available. Then you have the stamp duty. So there's no stamp duty for first homeowners up to $800,000 and it's on a sliding scale up to $1 million. So I think up to about $950,000, you can save about an extra $10,000 if you're a first homeowner and you're getting into $1 million property. There are some other schemes that people may not be aware of as well, which is for like single parent families where they only need 2% deposit to get back into the market. But again, there's a salary cap, so it does make it a bit difficult in Sydney where the salary cap is $125,000. And the other one they brought in last year is that if you haven't owned a home in 10 years, you would re-qualify for that first homeowner scheme. So if you hadn't had a home, so you're back onto the first homeowner. So that is another opportunity for people to get back into the market. Say if you 10 years ago, you may have had a divorce or something's happened, you had a house and you always think that you did have a house previously and you can't re-qualify. Well, they opened that up again for that period.
Yeah, that's amazing.
Yeah, so as you know, for the property market, I'll talk specifically on the Sydney property market. That has fallen, 2 years ago when interest rates started to rise. And now, given the positive, I would call it, positive economic outlook, the Reserve Bank may decide to reduce the interest rate next year or so. So what does the current property market looks like? And would it affect sort of the home loan application from your view?
The property market is very tight still. So what we've found is there's this massive lack of supply and that's basically driving the prices up. So I think we would have heard when they started rising, raising interest rates in May 2022. So 2 years ago, we've had, I think, 13 rate rises in the last 2 years. There was this media outburst that housing prices were going to fall by 30%, which just has not happened. And the main reason that has not happened is because we've had this unbelievable immigration policy where I think last year we had 600,000 people come back into the market. We had the borders open up to the students. So there's this huge supply of students coming back into the market. And there simply is not enough stock. And one of the statistics as well in COVID is that we saw another 160,000 houses being created, like because people were stuck indoors for, the COVID lockdown. And so people were either having to go to a bigger house, split households. So there was another 160,000 houses. So there's just this massive undersupply of stock. And we just don't have enough. The building levels are the lowest they've been since 2013 because of the whole construction industry. So what we're seeing is it's probably not going to be resolved for another, 10 years. People always want to get into the market. And because of all of that, we're not going to see house prices decrease, in my view, in especially Sydney, because there just is not enough stock. So what we're seeing is this massive migration to Queensland and out of Sydney to be able to, people to actually get into a house.
Yeah, it's a bit scary. It's almost like it's no better time than now. And talking about that, if someone's in the same situation where they're kind of listening to this and going, wow, okay, I really need to get my stuff together and let's get financially ready to buy a place. What are some key points that they should probably look at? I know you've touched on previously in a talk with Simon, getting your credit history and fixing all that up. Can you just run us through that and how that would actually affect someone and what else they need to get in order to then come get a pre-approval with you?
Mm-hmm. So I'll go back to the 3 S's. So we've talked about the serviceability, which is the income and expenses, and then there's the security. So that's the other thing. So looking at your savings and how much security you can put towards a property. And we're actually seeing one of the biggest banks at the moment is the Bank of Mum and Dad. And you'll hear about that in the media and stuff because there is this big generational wealth change as well. So we're actually seeing parents wanting to help their kids get into the market because, they're scared for their children as well. So there is all sorts of different ways to put up that security. So can mum and dad be guarantor? Can they give the kids a gift in terms of that? So that is the other thing of security. So we've got the kids' savings and then we've got other forms of security that can be offered. There is some options, for example, where we can have a term deposit in the parents' names and they get the interest. So that is another option besides housing because a lot of people are scared to put their houses on the line. So there are all sorts of options with security. And then we were talking about strength of character. Strength of character is that a couple of years ago we had open banking. So what that means is that banks can see absolutely every credit you've applied for in the past. They can, if you have missed a payment on any sort of bill or anything, they can actually see that on your credit report and you get rated. So what we do now with most clients is do a credit report before we even lodge a loan because one of the things that comes up a lot is, say, for example, they've been to Harvey Norman and they've got a fridge and they've done it on credit, interest-free or afterpay, and they've paid it off in the time because they've got like a 12-month interest-free period, and if they're diligent, they've paid it off in that 12-month period. But a lot of the time it's still on their credit file, and it will be the limit on their credit file, so which does affect servicing. And I think every month I get one of these, and I had a credit card from 20 years ago and it's still on my credit file because they don't know that it hasn't been closed off because Latitude, mainly Latitude, is on their credit file and it's mainly for, say, they've bought goods in the past, things like that. So it is important to know what is on your credit file. The other one that comes up, if you've had a credit card, for example, and you might have moved, and you might have a annual fee that's come up and they've posted it out to you and you have totally forgotten about it because you don't use that credit card anymore. And I've had a few like this where they might have a 1 or 2 on their credit report. What that means is that they haven't paid some portion of that repayment for 1 or 2 months, which is not good. And a lot of the times it's actually been just the annual fee of your credit card, which is $300. They have totally forgotten about it because they haven't used that credit card in 2 or 3 years. and now they've got like these marks on their credit files, and they stay on
Close
there
your credit cards.
So close your credit card, and those marks stay on your report for 2 years.
Wow. Okay. That's scary.
Yes.
Putting all that into that. Because I know a lot of people my age just jump on Afterpay or, there's a few out there, but they jump on them. They don't
Zip
think
Pay,
They don't
Afterpay.
think twice about it. They might have a few dollars left to pay and they go, okay, I'll pay it next month. But yeah, that's crazy.
Yeah,
It's crazy that it sticks.
and the banks can see all of that on your credit file. So it's always worth knowing what is on your credit file.
And then knowing what's on your credit file, is that obviously that's something that you come to a mortgage broker and you can get done.
Yes, we can do it for you. You can also go on to pay for it yourself, but yes, we can provide that service as well.
Fantastic. Okay, so on the strategy front, there would be some, let's say the client decided to purchase the property, find the property that they love, and now the next step is how do they know what are the sort of the overall costs, right? Because, it looks like it's just the property price, but actually there would be other costs associated to buy that exact property. And would you like to walk through what are the sort of the costs that people may not think about?
So, solicitors is a big one. So everyone would need a conveyancer, and you normally have to budget about $2,000 for that. There are OSR fees, which is the Office of State Revenue. So basically every time you get a mortgage, you pay around $300 for the Office of State Revenue to put it on their books and also take the other one off. So that's around about $140 each way. And then there is also their bank solicitor fees as well. So it's generally like an extra probably $3,000 of solicitor's cost with the bank and your own. There's also stamp duty, which is we hopefully know about, but as I said, that's on a sliding scale and it does vary a lot. But if you obviously under 800,000 and a first homeowner, there's no stamp duty now, which is about a $26,000 saving, up to $1 million, where as I said, it's about $5,000 to $10,000. There's generally a building if you're buying a house.
Pest and building.
Yeah, pest and building report that you need to pay for. So that's about $500. And I think that's about, so it's about $3,000 to $5,000 as well on top of your home loan and stamp duty.
Yeah, I guess we covered it so far. I think I'll sort of summarize it. It's extremely important to get a pre-approval before you actually start to looking for the property you like. And then we talked about the various strategies. How do we there are so many things to consider, the government scheme, the cost involved, the strategies you need to consider. And now comes down to sort of the actual execution of it. There are so many ways to get a pre-approval. So you can basically go to the branch of CBA or whatever, say I need a pre-approval, the bank can do that. Or you can find any broker that can help you to do that, right? So what would be the sort of the limits, or what would be the sort of the bank pre-approval that if you go to the CBA branch, for example, what would be the difference between you go to that bank compared to the other ones? How do you know which bank you should go for?
That's why you come to a broker, because we can pretty much do an analysis in 2 minutes of which bank's going to lend you more, and it's quite amazing different banks will lend you for different reasons. So I just had a case last week where the client's actually banked with a big yellow bank, and I was able to go to another bank and get them $250,000 more. There was different reasons, but banks have different reasons on different months. That's the living expenses. So some banks change it, as I was mentioning before, on a monthly basis. Some banks do it on a quarterly basis. So that can differ between what the minimum what their minimum living expenses can be. Some banks, if you're self-employed, will only take the last year, whereas some banks will take an average of the last 2 years. So it can differ quite vastly if you go to, if you just were banking with CBA, for example, as opposed to all these other banks that can offer maybe some more money in some cases. So at the moment, because the property market is so competitive, most people want to see what the maximum they can borrow is, especially if they are first homeowners, because they're going to have that loan for 30 years. So an extra $100,000, for example, over a 30-year period may not be that much, but it may be able to get you into a better house or unit at this stage. So that's one of the things we are seeing. People want to be able to maximise what they can borrow at this stage, knowing that their incomes are going to increase if they're a first homeowner, and if they can manage it now, and hopefully with the housing shortage, the prices will probably go up. So that's what, we're seeing probably.
Fantastic.
And what advice do you have for some of these first home buyers who are concerned about saving for a down payment? Because it is a lot of money that you've got to ideally save up if you're not doing one of these schemes to then get into the market.
Well, knowing where all your money goes, because I think today is, and I think I brought up this analogy before with my two girls, that like back in when we were playing shops, you, Jami, used to have cash, but then I had a daughter 5 years later and everything was on credit. So you don't see the money go out the door anymore. People just don't see that. Whereas,
tapping.
They just tap unless you actually know where your money's going. I think that's really hard because you can go and get a coffee every day. And that's like, you could save potentially
$5 a coffee.
Yeah, $5.
7 days a week.
Yeah, $35 a week, $140 a month. Knowing where your money goes, I think, is really important. And I don't think a lot of people just do that because it's so easy just to tap. So easy to go and, as you said, get a zip pay, afterpay if you want to buy some clothes. If you are really wanting to get into the property market, I think it's really important that you do know where your money goes. That's number one, and have a goal and a budget. And just be prepared to give up your coffees. Be prepared to give up not going out and maybe buying new clothes every month.
And do you help clients when they come to you? Do you have like a little budget template that you can help provide them and they can really break down their costs and see where everything is going and then work out where they can save?
A lot of people are too scared to even go through their living expenses, but we do. That's one of the, we do need to do that for part of the loan application. And I can pretty much benchmark it with what the banks are going to say. So people might have a lot higher living expenses, and we want to, obviously, to maximise borrowing as well. We want to make sure that their living expenses are within the bank's living expenses as well. And then I try and explain to them as well, like if you are living at home, you're not paying for electricity, you're not paying for food all the time. So it is like totally different when you're, living in a home by yourself.
Okay, so maybe I'll fast track a little bit. Let's say the client get a pre-approval, get the property done, living the property happily, and for a few years, maybe 1 or 2 years, and they still have their existing loan with whatever their bank is. And now what we find is for that particular bank, sure, they will have the best interest rate when you apply for it, but in 2 years' time, the other banks may have a better offer, right? So, but without doing extensive research on those offerings, how do you know the bank you stay with, they still give you the best offer in the market? And is there anything you should do about it? How do you know about it?
Well, I actually have a team now that actually does that. We do reprice people's loans on a yearly basis because exactly that. Your bank is not going to drop your rate for you unless you're going to say you're leaving. So that's one thing we have been doing quite actively at the moment, because obviously trying to save people's money. So yeah, you're right. But you don't know unless you're going to ring the bank yourself, they're not going to do it for you.
Exactly. So I guess the message would be, even if you get a loan, after 1 or 2 years, you should always review your loan with your broker.
Yeah? Correct.
Yeah, awesome. Obviously, that just shows how important it is to actually go on board with a broker and the difference that they can make in getting you the best home loan as possible for the best interest rates, and then obviously keeping on top of those rising rates and making sure you're constantly getting the best price. So that's really good takeaway, and thank you so much for sharing everything with us today.
You're welcome.
Thank you guys for listening, and we hope you tune in soon for another episode. Thanks, Daniel, and thanks, Sally.
Thanks all.
Thank you for listening to NavTalk. If you'd like to catch up on other episodes from this series or previous, head to our Navwealth website. Until next time.